Wonderful. So listen to me here. If you're an immigrant or a child of immigrants, you were taught just how to work, right? And how to work very, very, very hard. Now, our parents mastered something. Our parents mastered working hard, but they didn't really master how to maximize your work for you, right? It's important to understand that as children of immigrants or as an immigrant in your own self, right? You were taught mostly to master survival, but you must understand survival is not wealth. Most high income immigrants are still one layoff away from stress because income is not ownership. You must remember that. Tonight, I am going to show you a simple four category ETF structure that can turn a simple $500 per month into a million or more. So no stock picking here, no hype, no guessing, just structure. So if you're hopping in with me tonight, please, as usual, drop me a comment down in the comment section. Let me know where you're watching from. I usually like to know exactly where everyone is watching from. So let me know exactly where you're watching from, what state, what country. I would like to know that, right? Drop me a comment down there, let me know that. And also, if you're just dropping in, make sure to share this, invite your friends, invite close ones to join you on this live. Because with this live today, if you don't take away anything, you can take just one thing I'll tell you today. Take the strategies I'm going to drop with you today, and you should be able to kick off a portfolio. You should be able to kick off a portfolio and already start building wealth with that, just going straight from what I'll be dropping to you today. So you're all welcome for sure. And I want to make sure that everybody is well settled. If you need to grab a pen and a paper, please do that. Grab a pen and a paper. I usually like people to grab a pen and a paper because it's not enough to just listen. When you listen, you also want to take notes because the notes you'll be taking are the notes you're going to implement. And when you implement these things, trust me, a lot of things happens, right? So let's keep going here. Now, what am I going to be talking about tonight? I'll be talking about the simple four category ETF blueprint. This is a simple blueprint just to show that structure always beats intelligence, right? This is how the 1%, the wealthy people actually allocate their investments. Because with only $500, it doesn't even matter what amount you have. I'm just using 500 as an example, right? You could have 250. The more, the better. You could have $1,000 a month. But if you do that diligently, I'm not only telling you what to do, but I'm going to show you how to do and exactly how to position this. And remember, by no means this is no financial advice, right? I'm just a guy here sharing my opinion, sharing my thoughts. This is purely for educational purposes. So you have to do your own research because investment involves risk and you have to bear the risk because you're the one who is going to get the ultimate risk, right? So remember this, it is all about asset ownership. That is it, right? Nothing more, nothing less. So, what you're going to learn in this live stream tonight are the four ETF categories, right? That if you invest in consistently with even a minimum of $500 a month, you will certainly get yourself comfortably to the millionaire status. And I will show you the different steps, right? I will also demonstrate to you the period of time it takes, if it's 20 years or 30 years, what to expect from that. I'll also talk to you about the different fees that are involved because that is one of the things people don't pay attention to. People don't pay attention to fees. Fees is very important because there is a cost to managing the ETF that you invest in. There are some people in the back end who do research, who decide what companies are part of the ETF, what companies to take out. It is important to understand that that fee, even though it is minute, and a lot of times it's transparent to a lot of investors because most investors don't even know that there are fees involved. I am going to show you exactly how to maximize the investments that have the least amount of fees and make sure that fees don't eat up a big part of your investment by the end of your 20, 30-year period. So if you stay with me on this live stream, you hold your pen and your paper, you take down some notes right after this tomorrow, you should be able to kick off a brokerage account and start investing if you're not doing that yet. Now, of course, if you need additional help later, you can always reach out, right? I'm also going to show you exactly why compounding maths is what separates workers from owners. And the goal for everybody, especially people who listen to me, is to become owners, not to stay as workers. The reason why is because as a worker, your income is capped. As a worker, you can only have as much as you can put in with your physical energy. And you know that your physical body is not going to last for long. You know your physical body is not going to last forever. So your best bet is to make sure once that physical body is still strong, once it's still generating income, you want to slowly be moving a big part of your income and your wealth on the ownership side. Because on the ownership side, the wealth starts working by its own self. That's one. There are a lot of other benefits I'll talk about in this video. So stay tuned with me. Now let's talk about the first ETF category on these four pillar categories that 1% of wealthy people use to build their wealth. Guys, this is no fluke. This is no hype. This is reality. This is what happens. 99% of the wealthiest, this is the strategy they use to invest on the stock market. I am giving to you today free of charge for nothing. So if you can take this, go use it, do your own research, but take advantage. Let's talk about the foundational ETF. Now, what is this foundational ETF for? It's, of course, like it sounds, it's the foundation of your investment strategy, right? This is your core ownership, and it is comprised mostly of US based companies. And the reason why is, of course, US based companies are the strongest companies in the world. I am not the one who is saying that, not because I live in the US right now. No, it is what it is. That is what the market capitalization says. The largest companies in the world are mostly US companies. The most robust stock market in the world is the New York Stock Exchange, right? The stock market that has produced the most growth and profits over the last 20, 30, 40, 50 years is the US stock market. So I am just saying that we all are chasing where the growth is, right? So even if you don't live in the US, if you're listening to me, you live out of the US, go ahead and find out if there are some platforms like Interactive Brokers. Those are platforms that you can use to invest in the US stock market. So even though geography is not permitting you, you still have access through the power of the internet to take advantage of this information. So it doesn't matter whether you live in the US, you don't live in the US, you're an immigrant or not. Listen, this information is going to change your life forever, right? So we are talking here about the first layer, which is the foundational ETF, right? And at this layer, you're looking at an ETF like VOO. VOO is a Vanguard um it's a Vanguard ETF, which is an ETF is basically a bucket of stocks. If you don't know what an ETF is, let me just tell you briefly. An ETF is like a bucket of companies which are put together and slices are sold out in shares. So instead of investing in a single company and take the risk of putting a lot of resources in a single company, you want to invest in an ETF because it is a bucket, right? So VOO is a Vanguard ETF, and it's a Vanguard S&P 500 ETF. You have to understand that the S&P 500 is actually an index within the stock market. And the S&P 500 is a group of 500 of the largest companies in America by market capitalization. So the S&P 500, basically, when you invest in an ETF like VOO, you are really buying a piece of the 500 top companies in America. So what that means is that at every point in time, you are invested in the 500 biggest companies in America, which means, therefore, which means that if one of those companies is underperforming, the fund managers usually have a criteria which they select the 500 companies. So if any company falls below the 500 church mark, that gives them access into the 500 top companies, they will take that company out and replace it with a new company that has qualified. So at every point in time, you are sure that you are investing in the 500 top companies on the US stock market, period. So that is your foundation, right? Now, it's also important to look at how much growth happens with VOO. VOO averages about 10%, about 12% growth. The 10-year average growth for VOO is 12%, right? And of that 12%, of course, you are saying, therefore, that in a 10-year period, it averages 12% a year. in growth. So if you're investing, let's say $1,000, the first year it's going to be $1,120. The next year is going to be 10%, 12% of 1,120, and it keeps compounding. It's also important to pay attention to something called the expense ratio. The expense ratio is actually the cost of managing that ETF, because the ETF doesn't operate on its own. There are people who research these companies within Vanguard. There are people who make sure the right companies are in that ETF. There are people who make sure the ETF is working right and all those things. So there's a cost that goes into managing it. And that cost in the case of VOO is 0.03%, which in real numbers, it's about $3 for every $10,000 that you have to pay to manage that fund. That is very cheap. That is significantly cheap. And I will show you as we go along why that matters, why the expense ratio matters, even though a lot of investors don't know about that. Now, what are some of the holdings within VOO? The top 5 holdings in VOO are Apple, Microsoft, Nvidia, Amazon, and Alphabet. So basically, if you want to invest in Apple, Amazon, Alphabet, Nvidia, but you are afraid to invest in these companies individually, or you just don't have enough capital because their individual stocks are expensive, you can go ahead and buy a share of VOO, because when you're buying a share of VOO, automatically you are going to own Apple, Microsoft, and all these other 500 companies that are part of VOO. Now, for the foundational category, in addition to VOO, you have alternatives like IVV. IVV is actually an iShare company, and you have SPY, which is a SPY index, right? This is IVV has a 0.03% expense ratio, just like VOO, and SPY has a slightly higher 0.09%. Both of them actually go to at about 12%. So I'm just giving you 2 alternatives so that you don't think the only one that exists is VOO. But again, that gives you an opportunity to go and do some research on them and see exactly which one fits your needs, right? But that is basically the first layer of this 4 approach 1% index ETF. This is what the 1% use to build, safeguard, protect, and multiply their wealth over time. Now, let's make progress here. So let's do a simplistic example, right? Let's say you decide that you're going to be investing $500 every month in VOO. Now, within the first 20 years, that money growing at 10%, and we are using 10% here as below the average. So worst case scenario, let's even do that, right? You can do the math with 12%, which is the average every 10 years annually, right? But some years it grows to 16, some years 24%, some years 11%. But let's just take 10% over a 20-year period, and you're investing $500 a month. After 20 years, you are going to be sitting on 382,000. Understand this, you have just been investing $66,000 a year. So which means in 20 years, it is actually it is $120,000 that you've invested from your money in 20 years. But in those 20 years, because of the 10% growth, that money has compounded into 382,000. So you are really sitting on about 162,000 in growth, which means you've really doubled your money, right? But here is the kicker, guys, and here is what I want you to understand, right? Because it's a challenge, especially for most of us immigrants, because we don't come from a culture that has generational wealth that is passed on. A lot of times when the father of the family dies, or the patriarch of the family, or the matriarch of the family, somehow life resets for everybody. Everything gets lost and people have to start life all over. Now, understand this, right? It is important, just because when you're thinking of the kind of strategies I'm talking to you about, I am talking to you about strategies that basically can go from generations to generations. If you are meticulous, if you pay attention, you're disciplined, and you keep on those strategies, right? So the first 20 years, if you're investing just $500, you're going to hit 382,000. But here is the kicker, guys. And here is where I get ballistically obsessive about compound interest and investing on the stock market. Because if you hold that same amount and continue that same investment for an additional 10 years, your money grows from 382,000 to 1.1 million, $1,130,000. So it means for just an additional $60,000 of investing and waiting an additional 10 years, your money grows by over $750,000. That is where the power lies, guys. That is where now you start understanding the deal. So let's take a practical example. I am going to be 49 years young in March, right? And I know I don't look anything older than 21. I am going to be 49 years young in March. So it means, therefore, that if I do something like this, I start investing $500 a month. By the time I'm 69, I will have $382,000 in my investment account, right? And at that time, at 69, let's assume, of course, $500 a month means that is not all the retirement I'm planning on. I probably have other assets I could be living on, right? Now, at that point, which means if I leave that amount of money, I don't even add an additional dime on it. In an additional 20 years again, by the time I'm 89, which of course I might not live to that age, but it's no longer about me anymore. It's now about the people who are coming after me and the people who are coming after the people who are coming after me. So this amount of money, not included, not additional contributions, will slowly keep compounding. So by the time another 20 years go by, I don't touch the money, it will be sitting somewhere about $1 million. By the time another 20 years adds to that, which means by the time my grandchildren are adults in their 20, 25, 26, 40 years from the time I started doing this, boy, a lot of things, there will be very few things they cannot do. If there's someone who want to be entrepreneurs, they'll have money available where they can come borrow from that money without paying taxes, without paying the interest to a bank, and go establish their businesses. I know families in this country that have family trust for everybody in the family to leverage. So people who want to be entrepreneurs, their children, instead of going to take loans at banks and pay 5, 6, 7% interest, they can borrow money from the family trust. When they borrow that money from the family trust, the payments they use to pay back that money, once they borrow that money, the trust will buy a life insurance against their lives. And the money the monthly payments they make towards that loan, it will go to pay the premiums for the life insurance, so that in case anything happens to them in between, the life insurance will pay back that money. You see how people build wealth? Those are the things I want to teach a lot of immigrants, because those are the things that make a difference. That is how you understand how this country works, wherever you are, how you can plug into the investment ecosystem through the stock market and build significant value. Remember, a lot of us were taught to survive. A lot of us were taught to work hard, save, spend slowly, and die. We didn't have training in a lot of our immigrant families how to multiply money. Anytime there were conversations about multiplying money, either it was involving a very risky venture, which 99% of the times the money was lost, or it was looked upon as a bad thing. Money is the root of all evil. Money is not a very good thing, right? So if you stay with me, by the end of this presentation, you have a complete template that you can use and start building wealth right away if you haven't started. Or if you have started, this is going to help you start accelerating that process. Now let's go to the second layer, right? The first layer is the foundational layer. That's where I talked about VOO. The second layer now is the growth ETFs. Now, these are not only the foundational is a lot more stable, right? The growth ETF is actually for high growth engine. This is now where you are living your Land Cruiser or your big, Ford F-150, and you are getting into a sports car now. This is actually a Ford Mustang. You can even count this as one of those fast going cars, because you want to go a little bit faster. These are the growth ETFs. These are the ETFs that actually will help within your investment portfolio, within this 4 ETF strategy, to accelerate growth for you. The 10 years average growth is about 18%. And we're talking here about an ETF called QQQM. QQQM is actually a technology-based ETF that mirrors the NASDAQ. The NASDAQ Composite Index is where most technology companies is the Nasdaq Composite Index actually specializes in dealing and trading only with technology companies. So when you buy QQQM is an ETF that covers the Nasdaq Composite, and so it covers 100 of the top technology companies you can think about. I need you to understand that. So basically, these are high growth companies. These are companies that are only geared towards reinvesting money in the company to expand, to grow, to become more wealthy, to become more powerful, to make more money for the shareholders. So the average growth for this is about 18%, right, for QQQM. Now, the interesting thing is that the expense ratio is 0.15% for every $10,000. So that translates into $15 for every $10,000 a year that you pay in expense ratio. Of course, the top holdings in those companies too involved in companies like Microsoft, Apple, Nvidia, Amazon, Facebook, which is Meta. You have alternatives to QQQM because you must always remember these different ETFs have different prices. But don't always worry too much about prices because it doesn't really make too much of a difference, right? The reason why is because even if you, unlike before, you can buy fractional shares, which means that you don't need to have the entire amount of money to invest in that ETF or in that stock. You can actually have a percentage of the money, whatever amount you have, you can buy a fraction of that share, whether it's $1, whether it's $2, $3, whatever it is, you can buy something with it, right? So don't worry about it. I'll give you two alternatives to QQQM, which is QQQ, which has an expense ratio of 0.20, which is about $20 per year. So it's higher than QQQM, which is 15. And you also have SCHG. SCHG actually has about 16 to 17% growth if you take a 10-year period averagely. And SCHG, the expense ratio is 0.04. So that leaves us somewhere about $4 a year, $4 for every $10 a year. So that is pretty low expense ratio, guys. And again, like I said, just hang on with me. I will show you why expense ratio is very important, why you should pay attention to that, right? So the second layer is the growth ETF. And at this layer, you want to invest in ETF that actually is growing your portfolio, that is bringing now the growth in their portfolio, so that in the 20, 30 years you are investing, or 15, you are going to see significant growth. The one thing I want to remind you is that when it comes to investing, especially in investing on the stock market, in stocks and ETFs, your number one most powerful tool is time. Now, if you don't have as much time, the only way you can try to mitigate that is by number one, investing more money, or number two, investing in a way that their growth is a little bit higher, right? Even those tools still cannot compete with time, but it at least mitigates the loss of time you had suffered maybe earlier. So it is important to understand that when you are building this four strategic ETF portfolio, you have to include a growth ETF, because that is what is going to help you catch up with the lost time. I know that because most of the people I talk to who listen to my channel are in their 30s, 40s, and 50s. So these are people who work. Some of them are just starting to invest a little later in their life. So this four strategy portfolio, this four ETF strategy portfolio can actually be a beginning. This can be the place where you begin if you are just beginning, or even if you are in the middle. If you're confused, this is how you can kick off, and you can start significantly building impact slowly but surely, right? Let's see here. So, I want to remind you that if this framework makes sense, but you have been wondering how it will fit into your income or your family goals, right? That's exactly why on the 26th of February, I'll be doing a webinar called the Wealth Clarity and Legacy Blueprint webinar. No pressure. I'm going to drop the link down in the description of this video, and you can visit the link anytime. If you look on the screen too, you will see a QR code. You can scan that code. You also see information about my website where you can go to that link and secure your ticket. Take your time. You don't have to rush, but let's continue the presentation, right? So when we're talking about QQQM, we're talking about an average growth of 18% over the last 10 years, guys. So if you are investing $500, if you are investing $500 every month, over the next 20 years, you will be sitting on $820,000 if you're investing $500 in QQQM. Now, if you're investing the same amount of money, you hold it for 30 years, you are sitting on $3.6 million. Now, I want you to understand this. Compounding explodes after the 20th year. Okay, again, this is no guarantee, right? In finance, there's never guarantee. Again, this is just information I'm sharing with you. I am no certified financial advisor. If you need financial advice, you can talk to your financial advisor in your area. But I actually am an educator. I educate people, I teach people on how to understand these things, do it for themselves, and build a life of meaning, right? Compounding explodes after the 20th year, guys. In this case, the first 20 years at $500, 18% returns for QQQM, you are looking at 820,000. That is not shabby money. That is still significant money. It's not joke, right? But when you shift it to an additional 10 years, instead of 20 years, you do it more for another 10 years, you'll be sitting on $3.6 million. I know sometimes these numbers sound crazy, but it's realistic. These numbers are real because I've been investing for over a decade today, and I have seen the consistent growth that happens when you do this diligently. Numbers don't lie, guys. Numbers don't. People lie, numbers don't lie. It will happen. Some days the market will be down, some days it will be up, but if you stay the course, you're going to get there, right? So that's the second category of this 4 category ETF strategy, and that is the growth category. Now, let's do this now. Imagine, therefore, right, that you are 30 years old, or 35, or even 40, and you invest $500 for the first couple of years till about 15 years. What will happen? The impact will be significant. But then if you break at that point, right, and you live again for maybe another 15 years, what happens is that those other years, even though compounding has been happening, it could be more accelerated if there was additional money being invested in that account, right? But what I'm really trying to get to you is it's not about timing the market. It's all about time in the market, right? It's all about staying in the game and doing the simple things consistently. Now, let's talk about the third category. And usually, this category is very important because people tend to get emotional about investing and focusing only on the growth and the investment assets that have potential to grow fast, to grow heavily, and to grow big over the years. The mistake a lot of investors make, and if you're listening to me, you're part of my community, you know that I talk about this quite a bit because I don't always want people to be blindsided. The most successful investors are not focused on only growth, but they are focused on minimizing their risk and downside. That is what smart value growth investors focus on, right? So the third category I want to talk to you here is the dividend and value category. The dividend category is actually mostly for income and stability because dividend is the payment that a company makes to its shareholders as a thank you for owning their shares. So dividends are typically paid every 3 months, 4 times a year, every quarter. But you also need to keep in mind that your dividends are taxed like your income if it's short term. So there are qualified and non-qualified dividends. There are some details involved in that. I don't want to go too much into the detail. I don't want you to be distracted by that. But that's nothing to worry about. What is important to worry is that this third category is actually a category geared towards giving you stability and providing you an income source in the later points in your life. An income source which comes so you don't have to sell your stocks to have income coming in, right? So generally, this is the the most popular of this category is SCHD. SCHD is known as a dividend ETF, and this ETF has an expense ratio of 0.06%, which is about $6 a year. Average 10-year growth is about 11 to 12% for HCHD, right? Not too shabby, right? And no, it's less than 10, it's less than 10%. Average annual growth for SCHD is somewhere between I think 6 to 8%, which is not too shabby if you take it from the time of inception till today. But of course, if you take a 10-year period, it could be about 10, 11%. So HCHD actually has, these are the top five holdings for HCHD. You have Broadcom, you have Coca-Cola, Pepsi Cola, Cisco, and Texas Instruments, right? Now you have to understand the goal of this category of ETFs is actually to generate income and provide stability in your portfolio so that in the event of a downturn in the market, your portfolio doesn't suffer too much. So if now you have the growth piece, you have the foundational, you have the growth, and now you have the income piece. So that way, in the long term, as you keep investing in an ETF like SCHD or another dividend ETF like maybe VYM or DJRO, in the long term, as your portfolio grows, so is the dividend that your portfolio will be growing, will be paying grow. So at some point in your life, you can decide now to, instead of reinvesting those dividends, you can start cashing it out in cash. So when the ETF or the company pays you a dividend, you have a choice. You can either choose for the company to, instead of paying you the cash, then to transform that cash into shares of that company and reinvest it back for you. So you can either receive the dividend as more shares or you can receive it as cash. When you receive it as shares, of course, you don't pay no taxes. That goes back into your portfolio and you only pay taxes when you sell it at some point in your life, right? Now, when you receive it as cash, you have to pay taxes as actual income. But the interesting thing to understand is that, take for example, right? Let's say, for example, you build a portfolio like the example I gave, $500 a month, and it takes you maybe 15, 20, 30 years, you get to $1 million. At 3.5% yield, which is the average yield for this particular category, which is SCHD, the average yield is 3.5%. So at 3.5%, that means every year you have $35,000 coming to you as income. Now, I want you to understand this just for reasons of transparency. I am not a big fan of investing a lot in dividend portfolios early in your life. And the reason why is just because the dividends that it will generate after a long period of time is not as significant as the growth that investing that same amount of money, or at least making priority investments more on the growth side, could generate in growth. But you always have to understand that the number one thing you want to do is to mitigate your risk, right? So when you're mitigating your risk, you're actually asking yourself, how much time do you have? Again, I have another 20 years to invest in my case. So in that case, I can actually afford to invest a lot more in growth ETFs because I still have time to recover even when the market goes down or up, right? But now, as I get older, maybe 15 years from today, when I'll be 64 or something, I can switch or 50 something, I could switch my investment now to invest more in dividend-based investments like SCHD, because I know as I'm getting older, I need more income than growth, right? I just need to be having some monthly income, which I could be going around the world and enjoying my life along with my wife and family or whoever, right? So it's important to understand that thing. Now, you have to understand that assets don't get tired. What gets tired is people, because this is how you replace your salary. One of the ways you replace your salary is through passive income. And one of the most passive of all the incomes is dividends, because you don't do nothing. You just basically invest in that asset. You go to sleep, continue living your life, and it generates value for you, right? So that's the third category, which is the dividend category, which is actually the income slash stabilization category. Now let's talk about the fourth category. And this one is interesting because just like the growth category, it's not exactly growth, but it gives something called momentum to your portfolio, right? This is actually adaptive growth. So it rotates into leaders as time goes. So this ETF actually gears towards making sure that at every point in time, it has different industry leaders in this portfolio, in this ETF. So it rotates, it goes to different categories of the market and looks at the leaders in those categories. It could be in tech, it could be in retail, it could be in I don't know, quantum computing, it could be in AI, it could be in all these different technologies, and it tries to have a representation of those futuristic and momentum based investments. Now, you must understand that in this category, you have the ETF called SPMO. I want you to note that down. SPMO. SPMO is a very critical ETF just because a lot of people don't know about it, but it's a very powerful ETF. It's a momentum based ETF. It's an ETF that has been delivering growth for a lot of people over the last many years. Averagely, over the last 10 years, it's delivered between 17 to 18% in growth, right? The expense ratio is what is a little bit high compared to like Vanguard ETFs and Fidelity and all of those companies. The expense ratio is 0.13%. That means $13 a year. For every $10 invested, you pay $13. But should be told, it's not much. But again, it is higher than like a VOO or something like that. So when you are making a consideration too, you don't certainly want to focus only on the expense ratio, right? But you want to have all these different data points because that is what helps you to make an educated investment decision. You're not making an investment decision based on how you feel. You're making an investment decision based on the education and the understanding you have. So some alternatives for this is the MTUM, which is 0.15% in expense ratio. So that's about $15 for every 10,000. That one grew about 14 to 15% over 10 years. And there's another one called QMOM, which is 0.49%, and it grew about 13 to 14% a year, right? So now, when you're thinking about this 4 ETF strategy, you are thinking about number one, the foundation, which is VOO. The second layer is the growth, right? Which is QQQM. The third layer now is the stabilization and income, which is SCHD. And the fourth layer is the momentum, which is an additional acceleration to your growth, which is the SPMO. But that is not all about the story. You must understand that, right? That is not all about the story because in considering these different ETFs, I also looked at something. I also looked about the worst case scenario. What is the worst situation in terms of drawdowns for this ETF? Historically, what is the worst thing that has happened to them in the worst economic circumstance? So if you look at an ETF like QQQM in 2022, which is looked upon like one of the worst years for stocks on the stock market in the last decade or so. If you look at 2022, in 2022, QQQM was down 32%. The S&P 500, which is like VOO, was down 18%, and SPMO was down 10%, right? So basically, you are saying that, okay, in the worst case scenario, this is the worst case it has been in the last 10 to 15 years, all right? So that too gives you a sense of, okay, it's not too bad in the sense that if it recovers 17 to 18% a year, and we know that the stock market grows by averagely 10% a year. And we also know that every year there's a 78% chance that the stock market goes up because the stock market goes up 78% of the time and it only goes down 22% of the time. Then you can understand that, okay, if I invest in these vehicles projecting out 20 years, that's what I'm going to be able to expect at the end of the day. That is how you think about these things. That's how you build your investment plan. You don't just build it from nothing. You build it from situations that are numbers based, that have a track record, right? So let's keep going here. So I talked to you earlier about expense ratio. And with each of the categories I talked about, the expense ratio is listed. And the reason why I shared that information, because the expense ratio determines the amount of money you finish up with. You might think it is small, 0.13%, 1%, but I need you to understand that 1%, for example, because there are some funds that have 1% expense ratio. For example, one of the reasons I am big on people investing in their 401k just to the max match of your employer is because of the management fee situation. When you are investing in your 401k, this is what I coach my private clients, and this is what I coach people in my community. It's not advice. You can use it if you want to. It's for you to decide, right? With the 401ks, 401ks have mutual funds in them. And these mutual funds are different from index funds and are different from ETFs. Mutual funds are actually the only investment vehicles you can invest in your 401ks. But the good thing with mutual funds, they're a lot more conservative because they don't try to take too much risk. So they grow about 8 to 10% somewhere there. But the downside is that the management fees are usually 1 to 1.5%. And when you think about that, okay, for every 10,000, you have to pay 1% of 10,000. I think that's $110 or something. Well, maybe that's not much. But when you multiply that over 20, 30 years of growth and compounding, it becomes very significant. Think about this, for example, right? At the 1% expense ratio, which is $100 for every $10,000, right? The fees compound significantly. Let me give you an example. If you are investing, right, like we discussed in VOO, for example, over 30 years, you're going to end up at $500 at 1 point something million dollars. Do you know that if the fees is 1%, by those 30 years, you have paid $215,000 in fees? If the fees is 1%, I need you to understand that. That is how powerful fees are. That is why we need to understand why it is important to understand what the expense ratio is. Because most immigrants actually negotiate $500 off a car. We will haggle with the car dealership. We will ask for all kinds of discount, but we lose on the back end $215,000 without knowing. I don't know if it makes sense here. That is money that can even buy a house. That is money that can change lives, guys. So you need to understand exactly how this works, right? So think about it this way. If you are talking about an ETF like QQQM, which averages 18% over the last 10 years, right? If you're paying 1% in management fees, you know what that compounds in? Over 30 years, that's a difference of $700,000 in your total growth. Guys, I need you to pay attention to this, right? I need you to understand exactly how these things work. I'm not talking about them just to be impressive here. I'm not here to impress nobody. I'm just giving you the information that will help you make informed, intelligent, and decisions that will change your life and the life of your families, right? Pay attention to expense ratio. If you don't really understand deeply what that is, join my communities. Look down in the YouTube channel. You'll see links to join my communities for free. If you want to book a one-on-one call with me, book a one-on-one call. Let's have a conversation, because people don't realize these are the things that cost you money, but you don't know. With this simple information I'm giving you right now, I am basically, let's assume that you are going to be investing in QQQM over the next 30 years at $500 a month. With this simple 1 minute you've attended my live show, listen to me, I have saved you $700,000. I need you to understand that, because sometimes we immigrants don't understand how these things work. We are worried too much about what is upfront and we miss what is being lost in the back end. Right? I hope this information is helping somebody. If this information is helping somebody, drop me a comment down in the comment section. Let me know that you are getting value out of this. You know, when I'm presenting and coaching like this, I usually like to have interaction, because that's what tells me if you're understanding the things I'm sharing. Right? So let's look at the different portfolios based on your risk tolerance, okay? And I'm just going to give this real quick. This is just the different portfolios based on your risk tolerance, right? And it's important to understand that too, because with your risk tolerance, that helps you to be able to determine what kind of investments to get involved in. It helps you to understand exactly what kind of stocks or ETFs to buy based on how much risk you want to take, based on how much time you still have before you go on retirement. And listen to me here, retirement is not necessarily age. Retirement is not a time. Retirement a lot is income. So if you're thinking about your number, which is something a lot of people don't know, right? What is your number, for example? What is your retirement number? Retirement number is not necessarily your age. Retirement number is the amount of money you want to have so that the growth of that money is able to replace your income. That's what retirement number is. Right? So think about it this way, therefore. The reason why they talk about retirement more about age is because for most people, that's how long it's going to take them to get to that financial number. But there are different ways you can get about it, depending on how much risk you want to take, depending on how old you are, depending on how aggressive you want to invest, depending on how much money you want to invest. And these are some of the things I handle with people one on one during my coaching session when they book some time to come and get coaching with me. We can break down your specific individual situation. We can talk about your specific family situation, and we can build a robust, solid plan that if you follow and you continue to follow diligently, you'll see the results of the end. Right? So if you're in need of one of those, you can certainly book down. Reach me, leave me a message or book a call. There's a link down in the in the comment or in the description section of this video, and you can certainly do that. But let's keep moving here, right? Now you must understand that there are people who like to build an aggressive portfolio, right? So when you're looking at this forced ETF strategy, you also want to ask yourself, how do I allocate my money to this strategy? An allocation of your money to this strategy will be determined, like I said, by your age and the amount of time and your goals, basically. How much money do you want to make? How soon do you want to make it? How fast do you want it to grow, right? And so, based on this, therefore, if you are an aggressive investor, which generally are people maybe they are still younger by age, right? In their 30s, they still have about 40 years to work and generate income and invest and things like that. You still have about 40 or 30, 40 years to make sure that the market can go up and down and you can handle volatility. Then you want to assign maybe like 30% of your income, of your investment income to the foundation ETF. Then you want to assign another 25% to momentum. You want to assign another 25% to growth and then 20% to dividend. Dividend because you don't need it anytime soon. You still have a long time before you need income from your growth, right? So this is for builders. These are for people who are aggressive. Now, if you want to be balanced, and balance generally is people in their 40s. Again, this is not financial advice, but this is just based on numbers, age, time frame, risk, and all of that. There are people in their 40s who are very risk, who can tolerate a lot of risk, like myself. I invest a lot more aggressively, even though I'm in my 40s, because not only I can tolerate risk, but I also understand a lot more what I'm doing right now in terms of the additional individual companies I can invest in addition to ETFs, right? So the distribution of my portfolio in this case will be a little bit different. But for most people in their 40s, you want to be balanced. You want to make sure that you are not overweighing on growth because you don't have enough time to recover from all these market gyrations, right? So you want to make sure your foundation is 25 for a balanced portfolio. Your momentum will be about 25, your growth another 25, and then the dividend will be 30. The dividend, because you want to start focusing now a little bit more, you want to start making sure that the dividend portfolio is growing now, because you are slowly, in the next 15 years, maybe, or 10 years, you'll be going into a time when you need that income from your dividend portfolio. So I hope you're understanding. If you have any questions, please drop it down in the comment section, okay? That is how you structure these things. You don't just structure them by how you feel. You structure them based on a logical approach to some of the realities that you have. So the balanced portfolio is mostly for stabilizers, right? In fact, there is uh, one of the most legendary investors. He used to be a partner to Warren Buffett, right? I forget his name, but he said something. He said the easiest way to do it is you take your age and you subtract that from 110. So when you take your age, you subtract that from 110. The bigger number should be, if you no, you take your age, you subtract that from 110, and the result is what you invest in stocks and active and growth ETFs, right? And then the other percentage is what you invest in more conservative investments like dividend-based bonds and things like that. So think about it now, right? The conservative portfolio is more for preservers. So these are people maybe in their late 40s, 50s. You don't want to take too much risk. You now want to preserve your capital. You want to make sure that your money is not growing as fast, but you are not losing as fast in case of a market downturn. You want to put a little bit more now into into the dividend bucket, right? So in this situation, a lot of times people will have about 50% of their investment in the dividend bucket, another 25 in the foundation, another 15 in momentum, and 10 in growth. Just because at this point you are getting close to when you will start needing income from your investments. So this is basically to preserve your wealth and to be able to preserve your investments so that way you don't have any kind of losses that will come in case there's a market downturn or things go south. Now, each time I come to talk to you about all those different things and I share with you some of this knowledge and these different ideas, I usually also want to make sure that you don't just live only with numbers in your head. I want you to also live not only with numbers, but with belief in your heart and also with the understanding that there is a lot you can control, but there is also things that you cannot control. And you have to believe in the power of the Almighty. You know, I read a quote the other day that's very powerful. It said something like, pray like it all depends on God and work like it all depends on you. I really enjoyed that, guys. I really, really, really enjoyed that. Pray like it all depends on God and work like it all depends on you. That is the strategy I use in my life generally. In my life, I understand that things will never ever go all the way I like. I understand that in my life, there will be moments of difficulties. I understand that in my life, there will be moments when things will not work out. I understand that there will be moments when I might even be required to start all over again. I'd have started all over in my life a few times. So, mentally, spiritually, I always prepare to make sure that I am strong enough. I am mentally, emotionally, spiritually tough enough to handle the challenges. Sometimes it might be of stupid decisions I make. Sometimes it might just be by the very odds of life. Because in life, you are in one of three situations all the time. You are either coming out of a problem, you are actually in a problem, or you are heading towards a problem right now. Ah, I mean, I don't know if you feel me. In life, that is just how it is. You're either coming out of a problem, you're heading into a problem, or you are in a problem right now. So it is important to understand when you're doing all of this planning around investing and planning for your life. It's also important to understand that you need inspiration from somewhere. You need inspiration. You need spiritual fortification from somewhere. And by the way, of course, if you don't belong to the Christian faith, that is okay. You are still a brother, you're still a sister, whatever faith you believe in. I am just sharing this as something to inspire somebody, right? And I'm looking today at Proverbs 6, 6 to 8. It says, go to the ant, you sluggard, consider its ways and be wise. It stores its provisions in summer and gathers its food at harvest. Go to the ant, you sluggard, consider its ways and be wise. It stores its provisions in summer and gathers its food at harvest. You know, the ant is one of those creatures that a lot of people don't understand can be the number one mentor and teacher for you in life. I've learned a lot from the life of an ant. You know, the ants, number one, they are very patient creatures. Number two, they take a long time to build their termitarium by carrying one grain of sand at a time. But by the time they finish building that termitarium, there are termitariums that have been built to multiple hundreds or something feet tall, right? And you look at it and you wonder, how did these little creatures carry one grain of sand at a time with a little bit of sputum that they emit, and that builds the termitarium all the way to that height? It's the same thing when it comes to your own life. Because during the summer, the ants is making provisions, it is working so that during the harvest season, it harvests, it goes and looks for food, brings it back into that termitarium, and they don't eat the food all at once. They save some for the season when they will not be able to leave their termitariums to go and look for something to eat. That's how you have to think about your life, guys. When things are good for you, be grateful, but don't forget to continue to invest for the time when things might not be good. because what you are investing is what is going to tide you over when things are not good. These are things, this is what you are investing is what is going to take care of you at the time when maybe you can't walk anymore, you're not physically fit, you might have an emergency, or life just happens. There are multiple different circumstances of life that happens. And one of the things that really hurts people a lot is because when those things happen, they were not prepared for it. Because during the times when they were making money, they didn't think about investing. And at that point in time, they always felt like things are always going to be good. That is how the human brain is wired. Our brain is wired in such a way that we always think when things are good, we think things are going to be good forever. That is why when the market is a bull market and everyone is making money, people lose their guard. People forget to keep to their discipline. People forget not to buy companies that they don't know and trust. People forget that they shouldn't change their strategy. They should continue to invest in the companies and ETFs that they trust. They believe that the market is going to go up forever. And boom, when the market drops, they are rushing to sell at a loss. And that's when they suffer. So just like an ant, be patient. Just like an ant, be intentional. Just like an ant, be relentless. Have you ever seen an ant make a U-turn and go back? It's very rare. When an ant is walking, if you put an encumbrance in front of the ant, maybe a piece of wood, a stone, something, that ant will either climb over the wood, it will walk around it, it will dig a hole underneath, but it is going to go through that encumbrance. Whatever blockage you put in front of the ant will figure out a way to go through that. That is how it is designed. And like an ant, like this Bible verse says, like an ant, you must be intentional, you must be focused, and you must be relentless. A lot of times in your life, a lot of bad things start happening when good things are about to happen. That's how life works. I've seen it happen many times. Every time in my life I'm about to get a breakthrough, bad things start happening. It starts seeming like nothing is going to work, right? During those times, the small doors are closing so that the big door can open. So you stay focused, guys. Stay determined. Stay on top of what you're doing. Start doing it. If you haven't started investing yet, it's never too late. Start with what you have. Don't worry about an amount. Don't worry about what your neighbor is doing. Don't worry about what your friends are doing. What can you do? Can you come up with $200 a month? Can you come up with $300 a month? If you can come up with that amount, then you have a platform like mine where you can come learn how to invest that. If you need additional help, you know what to do. Guys, this is how it happens. This is how the 1% build the world they do. They don't build it overnight. They don't build it by happenstance. They don't build it by mistake. The average millionaire in America is 59 years old. The average millionaire in America never made more than never made up to $100,000 a year. The average millionaire in America invested at least 12% of their income consistently over 26 years. Guys, so I need you to understand some of these things. Always keep them as guides. Always keep them as a way of stabilizing your emotions when you get excited or when you get feeling like you are lost, or you're feeling like nothing good is happening, or you're feeling like you are the boss, you know everything. No, I am never arrogant about investing. I am very prudent. I'm very humble, understanding that there are some days that it will be tough. There are some days that it will be good. But if you continue to invest consistently, you follow the different coaching guidance I give, the transformation that I suggest, guys, your life will be changed forever. Because you need to understand something. It's never about emotions. It's about structure. It's about a system. It's about clarity. It's about understanding a repeatable process, because it will not work without a repeatable system that you can stick to for a long period of time. If you don't build assets, your children will inherit effort. If you build assets, they inherit leverage. They start up from a pedestal that gives them the ability to do more. The ETF is not magic. Discipline is the magic. Consistency is the magic. Sticking to the plan and not your emotion is the magic, guys. So I hope this helped you gain something today. And I want to remind you that if you really truly are serious about your financial life, you're serious about wanting help building this kind of portfolio with your income, your goals, and your lifestyle, that's exactly what we are going to be doing at the World Clarity webinar. That webinar is a 90 minutes webinar where we will help you organize your money, we'll build a clear plan, and you will live with a structure instead of stress. If clarity and speed matters to you, I will drop the link in the description of this video. If you're watching on Facebook, it's already in the description. Check it out, right? I'm going to drop the link for YouTube and Instagram. Check it out. Book your seat. I'm going to be dealing just with a small number of people. So the seats are not many, right? Book the VIP seat because that will give you a chance to actually interact with me and ask me some questions. It's going to be a live event. So everybody is going to receive the information live for the first 1 hour, 30 minutes. We are also going to give you a lot of different materials. We're going to give you access to watch the recording of that webinar for 30 days because we understand after attending the event live, you still need time to go back and watch it again to digest it. We're going to give you material that will help you build a budget for you, materials that will give you step by step how to start investing, how to set up a portfolio, what to allocate, what kind of assets to even start investing in if you are new to this game, right? We're going to give you in the VIP package, you have the ability to ask me a question and get an answer guaranteed. In addition to that, you will be exposed to other offers we have for a significant discount, right? So if you are really serious about trying to change things for yourself and your destiny and your family, then you have to be part of this webinar. And don't delay because the seats are very limited. We have only 45 seats. And once that fills up, we are right about 30 something. Once that fills up, it's done. We're closing the gate for it. So if you're planning on securing your seat, you want to really do that right away. So that way you are sure that you'll be part of that life-changing event. Guys, I want to leave you with this word, right? I hope you first of all benefited something from this live stream. And tomorrow, same time, 8:30 Eastern, 7:30 Central Time, I will be on. But before that, at 4 p.m. Central Time, make sure you join Dr. Edimo, my good friend out of San Antonio, a wonderful guy from Wealth Smart Advisory. We are going to be having a live podcast. We're going to be discussing some hot topics from the economy to stocks, to life, to inspiration, to legacy, to purpose, all those good things. Join us tomorrow live, right? You will see that on my channel at 4 p.m. Central. And then later in the evening at 7:30, I will be on again with the usual daily live stream. And tomorrow I will certainly share with you the topic of conversation. And if this is helping you, share it with somebody. Don't keep it to yourself. There is no need for you to keep it to yourself, right? You have to understand that the cake is big enough. You building wealth and becoming successful, it's not going to take away from the next person's ability to do the same. You must understand that even though we came from backgrounds where we were challenged with a little bit of luck, and because of that, our mindsets have been conditioned to think that there is never enough for everybody, I want you to start developing that mindset of abundance, that mindset of plenty, because if the mind cannot perceive it, the body will never achieve it. I want you to realize that the cake is big enough, right? The cake is big enough. Teaching people, helping people, becoming successful doesn't take away my own success. You investing and building wealth doesn't take away what I'm going to be doing for my own self, my family, and building wealth too. It instead adds to both of us because the more of us are successful, the less there will be envy, the less there will be lack, the less there will be jealousy, the less vices is. I know that a lot of times people say, money is the root of all evil. That's a lie to me. Actually, poverty is the root of all evil. Studies indicate, socioeconomic studies indicate that the greatest causes of crime is poverty. You go to communities which are poor, that's where you have the highest crime rates. Why is that the case? Why are they not the best people? Why are they not the most honest people? Why are they not the happiest people on earth? If you're telling me money is the root of all evil. No, it's obsession of money. That's the root of all evil. It's letting money become your master. That's the root of all evil. That is why it is important to understand why you are investing. It is important to have your goals clear. Why are you investing this money? What is it you want to do with it? Define those things. Because when you define those things, guys, it clarifies and it gives you momentum to continue to do it. Don't just say, I'm investing for retirement. No, go a little bit deeper. What is it you want to do? What is retirement? What age is that? What amount of money you want to have in your portfolio so that at a 10% growth every year, you can know what is available to you to spend. So, for example, it is generally calculated that most people will need 25%. Sorry, they will need 25 times their present income in order to live through a happy retirement. So let's say you are earning, excuse me, sorry. Let's say you're earning $100,000 a year. So you'll need $22.5 million, right? In your investment portfolio, which is a 401k, a Roth IRA, and I'm going to do a separate video just breaking down the order of investing in terms of the different buckets, whether 401k, Roth IRA, all those things. I'll do another video probably tomorrow or the day after just on that. So it helps give you a picture, right? But you need about 25 times, which means if you have 2.5 million in your portfolio and 2.5 million by the time you're getting to the age where you want to retire in terms of a number, of the amount of money or the number of your actual age, whichever comes first. What that means is if that portfolio grows by 10% a year, every year the portfolio grows by $250,000. So now, generally, it is estimated that if you want to withdraw from your portfolio without ever running out of money till you die, you should calculate the withdrawal rate at 4%. So what that tells me is if you want to have an income of 100,000 passively coming to you, I need you to understand this, which means you don't go to any work to make that income. It passively comes from the growth of your portfolio. Therefore, you want to make sure that 4% of the returns of that portfolio is $100,000. So your calculation now should be, okay, I need to grow my portfolio to X amount of money so that if it returns 10% a year, 4% of that 10% is $100,000. At that point, I can retire. And I know that not I can retire, but at that point, I know that if I'm spending 4% of what is coming out of that portfolio every year, I'll never run out of money. Right, and we'll go into all these details at the same at a different on a different video. So that's why you need to subscribe to this channel, follow me on YouTube, on Facebook, follow me on Instagram. So anytime I'm online, you can be able to know and you'll be able to certainly benefit from this. Guys, it's very important to take your financial life seriously, right? I don't spend the time coming every night to share this information. I understand how important it is, and I believe that a lot of people are going to benefit from this, that a lot of people are going to see value and be able to change the trajectory of things that will happen. Let me tell you something. Don't get caught up in the perfectionist mindset. Don't get caught up in the anxiety that you are behind all the time. No. Focus on understanding that any effort you are putting takes you, if it's not taking you where you are where you wanted to be at that time, but at least it has taken you out of where you used to be. That is progress. Because one of the things I've noticed with some people who come to my coaching programs, even when they are doing well in life, they feel like they're not doing well because they're either looking at somebody else's lifestyle and feeling like maybe they should have had that kind of lifestyle. I have had people come to me and in the initial conversation, they have portfolios, they have a 401k, they have assets, they have things that are upwards of $1 million. But somehow they're still feeling this feeling inside like they cannot afford to not do something. They cannot afford to, they are feeling this stress and anxiety. You have to understand money is a tool. Money is not the be all and all, guys. I take it seriously. I talk about it, but I want you to understand that it's a tool. Money is actually the value of money is what it permits you to do. It's the freedom it can buy for you. It's the options it can give you. It's the ability to permit you to do things with your life that makes sense. One of the things that is important to me, for example, is the fact that I want to be one of the grandfathers when I come to my daughter's home. I have 3 beautiful girls. By God's grace, they'll get married and be blessed with beautiful grandchildren for me. That is my prayer every day. When I come to visit them along with my wife and we're living, I want to leave them a check for their grandchildren. I want to make sure that the grandchildren are secured. I remember I worked one time when I was on LVN. I worked one time in a home care case for this rich guy. multi-millionaire. He built a company doing collections for the healthcare industry. And I remember I used to go there on weekends. So Saturday mornings I work from a 7 a.m. shift to 7 p.m. And one Saturday I got to his house right about 7:15 after taking report. I went to greet him in his room, and by his bedside I saw some two checks, each for $25,000. So I was wondering what he was going to do with it. And then right about 10 a.m. in the morning, these two young ladies came out. They drove into his compound, and they came into his room. Grandpa gave him the keys and held him, and they were chatting with him. And these kids were probably 18, 19 years old. And they chatted, hung out with him, made him some coffee, spent some time with their granddad. And when they were leaving, he gave them those two checks. Now, I didn't really understand what happened because I wasn't in there when that happened. How did I know about it? It's because his son came later that afternoon and he was so angry. He started screaming, Grandpa, I have told you, stop spoiling these kids. Why are you giving them so much money? What do you want them to do with that kind of money? Why are you giving 19-year-olds $25,000? And he looked at his son and he said, Son, I gave you the company. It's worth 70 million. What else do you want me to do with my money? I got to spoil my grandkids. Right? So, but anyways, define what it is for you. A lot of people don't realize that money is a tool. Money is not the end. Money is actually a path and a lubricant in life towards the end. So don't get caught up too much with the anxiety of always feeling like you're behind. You want to be realistic with your situation. You want to work on the situation. I agree with you, but don't steal the joy of your life completely because you are not where you were supposed to be. I don't know if I make sense. That is very important because when it's all said and done, the older you get, the more you start valuing things that are not material, but more about things that gives you freedom, gives you latitude, gives you options, and gives you a certain kind of contentment that you are contributing to humanity. You must understand that, guys. So it's important to define those things, right? And when you define those things, you put a plan in place. When you put a plan in place, you start executing on that plan. Rain or shine, execute. The thunderstorm or calm, execute. Bad times or good times, execute. Continue to execute because it's more of a behavior than an actual action. It's a behavior, and you want to train yourself to do those behaviors subconsciously. All the things I am good at in my life that I've worked on to become great at, I didn't leave it only to my mind. I left it to focus. I worked on it so many times, it became subconscious to me, so much so that it becomes a habit. For example, I've committed to myself that for the year 2026, every day I will try to do a live stream to educate people on something about purpose, about building wealth, about finance, about building a lasting legacy. Now I want that to become second nature in my habit, so much so that wherever I am in the world, when that time reaches, my body tells me I got to do it and I just do it. It doesn't have to be long. I'm doing it now for an hour because I have a lot of things I want to talk to you about. Eventually, it could be maybe 30 minutes, 15 minutes, 45 minutes. I don't know. The time doesn't matter to me. What matters more is actually the impact. What matters more is what it does to you, how that can transform you, because that has transformed my life already. And it continues to transform my life and the life of my loved ones. The important thing is how that is transforming your own life. What is that doing to you? How is that giving you a chance to be able to be optimistic about what lies in your future? How is that giving you an opportunity to not only be optimistic and enthusiastic, but actually have a plan, and a plan that actually can work? A plan that is not based out of how you feel, but a plan that is based out of numbers and a track record and a proven strategy. That is why you must be part of my webinar on the 26th of February, because it's all about strategy. It is all about clarity, and it is all about a system that you can follow. So, guys, I don't know where you were born. I don't know where you're watching me from. I don't know the circumstances by which you were raised, but I want to remind you that maybe some voices talked upon your life. Maybe some circumstances, some people made you believe that you are not enough, that you're not smart enough, that you're not strong enough, that you're not capable enough, not only to build wealth, but to also build a life of meaning, to figure out what your purpose is, to find contentment and happiness. I want to tell you that you are enough. that you are smart, you are intelligent, you're strong, you are capable enough. You want to make sure you keep your mind and you want to make sure you keep your spirit on the side of positivity. It is an intentional action, it's not automatic. The human spirit by default always defaults to negativity. The human spirit always defaults to a feeling of lack. The human spirit always defaults to a feeling of not enough. So it takes a certain amount of consciousness to stay on the path of positivity. And if you want to build your life, you want to build a life of meaning, you want to build wealth, you want to build a lasting legacy, you must be intentional about staying around the people and the circumstances that are leading in that direction. Remember, comparison is a thief of time. Define what happiness is for you. Define what luxury is for you. Define what a legacy is for you. Don't define it by what you perceive it is for somebody else. That is when you get in trouble. That is when you start feeling anxious. That is when you start feeling like you are not enough. And that is when you start feeling like you'll never get there because you don't have a goalpost. Your goalpost is dependent on somebody else. And as the person moves, they carry along that goalpost and you never get there. Guys, I hope you have a wonderful evening. I hope you found some value in this. You have a good time. God be with you. Make sure to subscribe to the channel, share this video, and I'll see you at the webinar. If not, I'll see you tomorrow during the next stream. Until the next time, be well, be blessed, and by all means, never stop being a blessing to somebody. Bye for now.